Thank you so much for this invite. It's always a pleasure to be with my IDC family. Joining us later today will be Richu Baines. For those of you in Ontario that don't know me, my name is Angelina Bazra. I'm the sales director here handling IDC for almost 6 years. So today I have a really interesting presentation. Hopefully you find some value. I'll be discussing the life cycle and your investment solution. Today's agenda is going to be the investor life cycle and behavioral bias, the life cycles of stocks, which is a super interesting topic, and then IA investment solutions. Rishu will be partnering, we'll be discussing the IA Premier program, and she'll close off this webinar. So let's get right into the topic. The investor life cycle and your assets over time can be bucketed over 5 and 6 different periods. We have the inception, the young growth, the mature growth, the stability, and the eventual decline. On the chart next to you, or the infograph, you see different, stages of one's life cycle. You're probably most familiar with this, though, which is the generational buckets of these said life cycles. And by the way, this research that I'm presenting to you today is borrowed from an NYU School of Business, Stern School of Business professor, Aswath Damodaran. Right now, I'm reading his book, and it's super interesting. I'll be citing it at the end of the presentation as well. So we're all familiar with whether you call it marketing or these concepts, but generational Gen Zs are obsessed with well-being. Right now they represent the largest demographic in history. Millennials, bucket I fall under, are defined by taking opportunities depending on whatever life events they're, faced with and are going through at the time. Gen Z, they're preparing to transfer wealth to the next generation. However long that may take, they're definitely starting to discuss a plan and have those discussions in place today. And finally, boomers, they value security and prefer comprehensive coverage. So investor life cycles in general can be bucketed through these different generations. But one thing they have in common, no matter the point of time or period they fall under, is the requirement for having a sufficient savings account to take them through those different stages. Starting with our ESPs. This is the perfect door opener product. At IA, we offer them for a child age 0, just as long as you have a SIN number. But moving past just the contract structure, I wanted to point out the similarities between different points of time and your investment needs at that period of time. So when you're planning a family, as an example, you're an advisor walking into a meeting, that child is 0. In 18 years, that child will need that investment money to pay for their education if they decide to go to post-secondary education. But that you have 18 years. So an investment strategy could look like from age 0 to 10, you're invested in a growth fund, as an example. And then from 10 to 14, you're invested in a balance fund. And finally, for those last 2 years before the child goes to school, you can kind of pivot to an income fund, so fixed income or high interest savings account, just so that the money, stays intact and doesn't have to be subject to any market gyrations. Finally, or next, we have the FHSA. We know that there's a saving stage that is about 15 years. You can accumulate to eventually purchase a home. The FHSA is purely for purchasing a home. So your savings plan could look like, for the first 15 years or even 10 years, you'd be invested in a growth fund. And then the final 5 years, as your client is looking for a home, they're doing their viewings, they're going back and forth pitching, potentially more different mortgages with different banks, seeing what they qualify for, just fine tuning their massive purchase. At that point, you want to put that money in a high interest savings account or even a bond product, an income generating product, something safe. Similarly, we have the RRSP, same concept, right? So you're walking into a meeting, for certain at age 71, your client will need to take a RIF income by law. So what does that mean? Up until that point, you can determine with your client and their investment needs what stage they're in. Are they in the growth stage? Are they accumulating maybe age 25 to age 45 or 50? They're interested in saving as much as possible. Maybe they want to take some higher risk in some aggressive funds. At that point, for the first, 30 years, for example, as they're accumulating, that would be a growth strategy. And then towards their 60s to 70s, they're looking at maybe helping their children purchase a home, or, if they need to take that emergency, deposit for whatever reason, maybe they're real estate agents, the market has taken a turn. Maybe they wanted to access those funds at a point in time where their income is lower than when they put they put that deposit in. Maybe you want to look at a balance fund or an income fund. And finally, at age 71, you want to start triggering a percentage of that portfolio into something that generates income. So at IA, we have different options, investment options, and different, funds and all that, all sorts of investment solutions for your clients that involve every single stage of their life cycle. And you're probably familiar with this. You've seen this chart at various IA presentations, but you really want to be with your client, engaging through the generations, getting to know their children, getting to know who's going to be the recipient of that wealth transfer. Maybe, helping them purchase a home with the FHSA, having a baby, the RESP, and finally planning for their retirement. Our RSP, the one big assumption when you're purchasing an RRSP is at age 71, your client will be making less money than when they put into it, because that's when they're, taking that income. However, you and I both know there are a lot of folks out there, boomers, Gen X or Gen Zs, that are still working and are probably reaching, the height of their career, closer to 70. So their income levels are actually increasing the closer they get to retirement. So that's an interesting phenomenon to consider, which means, perhaps you're speaking to your wholesaler about non-registered accounts or maximizing a TFSA strategy. On that note, I wanted to pivot a little bit to what the risk return spectrum looks like. And so in front of us, everyone's familiar with this. We have the return spectrum, and then we have it against risk. And as you know, the older you get, the more prudent, right, you generally tend to become as an investor. But there's a lot of other aspects that advisors, tend to overlook when you're looking at a client's risk return spectrum. So you're doing the KYC and you're filling it out, but, don't forget there are behavioral biases that every investor, is subject to. And all of these factors also determine how much risk a client is more apt to take. So definitely don't forget, an investor's personality and traits and psychological biases play a crucial role in the way investors think about risk, and risk determines the type of returns an investor tends to have. Let's look at the conservative investor as an example. Anchoring, that is a behavioral characteristic that, for example, let's take an example. How many people here know somebody who talks about when Amazon stock was less than $1 in 2000, right? This is the generation where you saw Amazon, go up. I saw Tesla go up. And so I'm sure a lot of people here, definitely know people when they're hitting themselves in the head going, oh, I should have bought Amazon stock in 2018 at $2,000. And so if your reference point is a point of time when Amazon was less than $1 or Tesla was less than $100, you are a conservative investor. That is the way your psychological, your personality trait is catered towards. So, for example, I think I have a lot of friends in the growth arena. So they're definitely growth investors. Perhaps very well educated, CFA, MBAs, guys who work in finance, women who work in finance, and they have what says here is the gambler's fallacy. So I'm in a couple of group chats. January, people were telling me, I'm going to take leverage. They don't have mortgages. They don't tend to take leverage, but I'm going to take leverage and pop that into NVIDIA because I'm hoping that thing is going to go to the moon, right? That Wall Street bets crowd. And, you look at that and you're like, well, I hope it works out for you, right? But you kind of can tell that this person might be overconfident or, have a higher aptitude to take risk in the form of gambling. And so that is categorized as a growth investor. However, you win or you bet big, right? Tends to, if statistics and luck is on your side, win big. And I remember in those conversations, those group chats, I would tell my friends, dial it back. You've almost doubled your money. Take the money off the table, right? And so I'm definitely falling under the bucket of aggressive investor. I have self-control. I understand I don't need to take, investment doesn't need to go to the moon for me to make money and me to be happy. Ultimately, I'd be okay with 20%, 15%, whatever that percentage looks like, as long as it's stable and it reoccurs annually. And that's kind of a good litmus test to understand how your clients, your end clients, think about risk and reward and where they truly fall in that spectrum. And so there definitely is a partnership between risk reward. And at IA, we have a ton of options that provides you with investment solution at each stage of your client's risk return profile. So we have GICs for someone very conservative. They're not interested in taking risk. They'll only purchase Amazon if it was under $1,000 a share. Right now, it's under $200. Then we have our IA Global Dividend. I would say it's a moderate balance fund. Then we have the IA Dividend Growth, which is the Canadian fund, dividend paying, also a bit moderate. Then we have the IA True Conviction Fund, which is categorized as an aggressive fund. And that fund, these two funds in particular, the IA Global Dividend and the True Conviction, I'm going to be profiling in the next slides. So just to recap, I challenged you to challenge your client to really think about what their investor risk tolerance is, what behavioral biases they might have or psychological biases that may determine how much risk they're interested in stomaching when you're buying stocks and funds in particular. Again, this research that I'm presenting to you is taken from Aswath Damodaran's book, The Corporate Life Cycle. And in particular, he outlines 6 stages where companies would fall under, depending on where they are in their life cycle. And I think this concept of understanding a person's life cycle and a stock's life cycle is super important in today's, just today's marketplace, because we're seeing certain companies, the Magnificent Six or Five or whatever that number is, really dominate indices. We're seeing Amazon, Facebook, Google, those companies really take a large market share. And, as such, you're probably thinking of top funds at companies you may use, IA, Manu, Canada, Sun. What are their top funds? And it hopefully isn't a surprise to you to see a balanced fund would have Microsoft, and an aggressive fund would also have Microsoft. And the reason for that is there is, diversification. Obviously, that's the motive of investing properly, but understanding that companies have a specific role to play and they also have a life cycle. So I'm going to be discussing top stock positions in our Global Dividend Fund and the True Conviction Fund. No surprise, Microsoft is here, and we categorize it as high growth, Intuitive Surgical, ICE, and Relics. Some companies you may not have heard of, but they're huge and core positions in our portfolio. And I'm going to demonstrate to you why it's important to think about these companies and understand where they are, and potentially have those discussions with your client, because now when you're consolidating assets across companies that they may have investment accounts at other companies, they may be over diversifying, and some of these positions are in multiple accounts. So let's look at a company, Intuitive Surgical. Intuitive Surgical is about 2% of our True Conviction Fund. It is only less than a year in the fund. So it's a brand new company that we added. The future of surgery is minimally invasive. Essentially, robotics performs surgeries better than fourth quartile surgeons. This is an up-and-coming phenomenon. We're seeing a lot of investment go towards robotics, especially surgeries. I have a brother, he is a doctor in California. When I ask him, what's the most challenging aspect about your job? He often says is, being in that surgical room, dealing with a gunshot patient, gunshot to the head, I have to be able to stand on my 2 feet for 7, 6, 8 hour surgery. And that's actually challenging for aging surgeons and doctors. But the great thing with AI and this robotics technology is that doctors are able to sit down during procedures and use robotics. And so, as we know, doctors it's quite a demanding job. You're always on your foot. Also, you're always thinking, you're mentally engaged at all times. So I do think this is an early stage development, and this is an example of a business that's capitalizing on AI and physical technology to make healthcare better. As such, doctors will perform surgeries later on, no longer retiring at age 80 because the physical demands of the job they can't meet. This is excellent because we know there's a global shortage of doctors. So this is a position in our True Conviction Fund, and I do think that this concept has legs to grow. Secondly, high growth. We think of Microsoft. It's interesting for anyone who had children in the 80s, right? Microsoft was just taking off, right? It was Bill Gates and it was a big business. And now we look at today, and Microsoft is a software that's required for every single business globally. So, Microsoft, you will find in the aggressive portfolios, you'll also find it in the balanced portfolios, probably for two different reasons. Microsoft is the largest shareholder of OpenAI. OpenAI is a nonprofit dedicated to AI research, and they are one of the biggest beneficiaries of that company and obviously that global phenomenon. So you can say that is a global aggressive theme, right? That will show up in a aggressive portfolio, but also at the same time, you're getting a company that's about 4% of our funds, True Conviction, as well as Global Dividend. You're getting a company that has high quality exposure to huge themes right now, such as cloud computing and AI, and also cybersecurity and other aspects. We know a lot of folks on this call, as well as me at work, everyone's using Teams or Zoom or something like that. These applications were quickly rolled out by Microsoft. So very agile company, only 40 years old in that high growth period. How do we categorize a company as high growth? Well, we look at the earnings from 2009 to 2017, single digit earnings, single digit growth. Then we fast forward to 2018 to 2024, low teens growth. This is how you categorize a company from high growth, from growth to high growth. Now we're going to talk about mature growth. Intercontinental Exchange is a company, it's at less than 2% of our True Conviction Fund. You probably haven't heard about it. I don't blame you. But they own a lot of infrastructure in the financial institutions. As an example, they own the New York Stock Exchange, the New York Board of Trade. They're a core holding in IA's Global Dividend, as well as global financial transactions. They own the COMEX, which is the exchange for global currency, the ICE Futures Exchange, as well as clearing houses. So definitely a company that owns the plumbing and infrastructure as it relates to placing trades and securities and futures and so forth. So a mature growth company, you don't see it going anywhere. It's just going to continue, and it's been growing through major acquisitions, including businesses in the mortgage transaction sector. So that's an example of mature growth, but not going anywhere. Finally, we have a company here over 100 years old, right? We think of the oldest companies. Usually, your mind probably goes to Japan, but Relix is very old. It's over 100 years old, and it's been continuing to grow. You've probably never heard about it, but Relix owns research. You probably heard of the show Grey's Anatomy. Grey's Anatomy is the oldest medical journal in the world, also over 100 years old. Relix owns that journal, as well as LexisNexis, which is the legal software for lawyers to find precedent on cases, etc., as well as other research tools, academia, government, and healthcare in healthcare sector. So the point here is these journals feed data to research companies and investors. So we're able to track what data is important, what studies are getting the most views, what research is getting the most traction from scholars in academia, because that's what drives change, at the human level. That's how we create advancements. That's how venture capitalists know what to invest in through this data. And so Relix has been around over 100 years and continues to provide strength in organizing data. This is a company that is in our Global Dividend Fund, and it is categorized as mature stable. I wanted to point out that all of these stocks that I provided, when we're looking at this chart, that's right in front of you here, 6 different stages. It's interesting to note that each stage may be 100 years old. It may be a period of 100, 200, 300 years. So there is no time frame in terms of years that categorize when a company stays in stage 2 and graduates into stage 3. So that's the interesting thing to note, that the life cycle is actually pretty long. So the gist of what I'm trying to present to you today is have a closer look at the funds that you're selling to your clients, that you're positioning alongside other funds, maybe a balanced portfolio, and really understand what is the total picture here. Like, how much assets are actually towards Microsoft, or how much assets are in Amazon, really figuring out that overlap, because sometimes adding a whole bunch of funds actually, creates over diversification, and you really want to have control over what positions are where. And the more overlap, actually, the more high conviction your client's portfolio ends up being. If you didn't want to, guess and do that deep dive that I'm suggesting, you can follow this template in front of you. Whether your client's prudent, moderate, balanced, growth, or aggressive, these are the 7 funds that you select, and these are the different percentages that you allocate towards each fund. And finally, on that note, before I pass it off to Rishu, I wanted to point out it's so important to zoom out. There's a lot of data, a lot of information, and a lot of innovation. And all that is coming to us real time. And it can be hard to process. I know Don is excellent at processing technology and changes and so forth. But there are a lot of nuances that you may not understand. So it's important to zoom out and really have a look at, despite the geopolitical issues, despite, advancements, and, whether it's detracting or, adding towards overall company growth, the market always goes in one direction, and that is up. There may be periodic declines, but the market trends upward. On that note, if you don't know me and want to get to know me, please reach out to your excellent BDMs in the region. There's so many of them. I will not mention all of them, but please reach out to them, as well as your wealth leader. They can funnel you my information, as well as other sales directors here at IA on the investment side. So on that note, Rishu, I'm gonna pass it off to you. Thanks for your time.
That was such an excellent presentation. Thank you so much, Angelina. I think we just had somebody mention that on the chat as well too, that they love your passion when it comes down to the conversation. So we have incredible support right across Canada when it comes to our whole IA squad, as I like to call it, whether you're talking about life, whether you're talking about living benefits or investments. Angela went over quite a bit of information in terms of to be able to support you as advisors as you grow in different aspects of when it comes down to the market cycle and the conversations that we can provide. What I wanted to do was I wanted to be able to showcase a different side of IA as well, to really, again, how not only do we support our advisors when it comes to training and strength of IA, but really, again, how we support you as you continue to grow your business as well too. So I'm hopefully you guys can see my slides as I work my few different screens here. But today's conversation is really going to be about supporting our advisors in different life cycles in terms of not just on the education side of things, but as you continue to grow with IA. We have done a quite 360 when it comes to the growth of IA and the changing landscape of IA, specifically around our product shelf. So as you saw, the different conversations we're currently having right now, we've been able to explore those with the partnership of our advanced casing, our IA large case solution. So if you have a second before I jump to the next screen, if you want to take out your phones and take a photo of this QR code, you'll be able to access our IA advanced case solutions website. It's a great resource tool in terms of marketing material that has been posted, with regards to really growing the advisor as a whole. We have an IA advanced case solutions team that is spread across Canada, from accountants to lawyers, that are able to support our advisors on the growth of each advisors, and again, the conversations that you're having in the market cycle today. Amazing client presentation that we're able to partner with you and be able to provide for your clients. Whether you're talking about investments conversations, whether you're talking about life conversations, many of these are currently available on our online platform of Evo already. Many of them can be available to you with partnership of the conversation with your sales director. So what I always say is, if you can reach out to your sales director and they're able to have that conversation with yourself and be able to showcase the strength of IA with our client custom client presentations, we're more than happy to do so. Here's like a little bit of an example that we do have available. Net return of a life insurance product, investment versus insurance comparison. And this is a brand new tool that we just launched currently right now. This is taxes as debt tool. And again, a clear picture in terms of how you're supporting your client and what the savings can possibly be versus, again, the taxes that they have to pay. It's a huge conversation to be able to put these custom client presentations in front of the client and really take that conversation to the next step. How can you have access to these tools? Again, as Angela mentioned, we have an amazing team spread right across Canada. So please get in touch with your regional sales directors at IA. They will be able to partner with the advanced case directors and be able to provide you the solutions on our custom presentation. Again, if you wanted to do a quick scan of the QR code or access our website, we will also be able to provide everybody that link as well too, so you can have direct access to the website as well. You don't have to have advisor code or to be able to access this. This is available to all of our advisors to be able to showcase the strength of IA and really, again, the changes that we've been able to bring on board with IA. Now, a huge conversation that we've been able to have currently right now, and we've really been having and really been the premiers when it comes to this conversation, is the way we support our advisors, not just on our continued production bonus or our business development bonus side of things, but really, again, growing the advisor as a whole. You have great compensation programs that run side by side to be able to support our advisors, whether you're on the insurance side, whether you're on the investment side, but really, again, to be able to launch our advisors to the next level, whether supporting their education in the field that there are currently right now or exclusive services to take their business to the next level. You actually get priority services from our advanced case team if you're a loyal IA Premier advisor. You have one-to-one marketing advisory services with experts to really be able to customize and train the training conversations that they're having with you. I know a huge component of a few advanced presentations recently has been the conversation that's centered around visibility when it comes down to the online conversations. Now, IA has a great online lead generation program that's called Find an Advisor, where if you are a loyal IA advisor, that's part of our CPB or B2B bonus program, you're able to get these lead generation programs be available to you, where clients can go online, search for their local advisor that are around and be able to have those additional advisors get added, clients get added to your portfolio. Again, we're trying to get the harder conversation out of the social media game. You know, social media it's a difficult conversation on a day-to-day basis. You know, where do you find the time to create those posts? Where do you find the content to create those posts? Are they compliant? Are they not compliant? We actually have a showcase program that is available to all of our advisors. This is not restricted to our CPB B2B advisors, but this is available to every single one of our advisors. If you log into IA Advisor Center, you can access these customizable posts already pre-done and compliant for you. Whether you're talking about Facebook posts, whether you're talking about LinkedIn posts, you're able to go online, take a look at what content that resonates with you, whether it's insurance, whether it's savings, and be able to add your information on it and post it on your social media. Now, I know I'm already at the end time, but I just wanted to highlight again, we are here to support the advisor on the full growth conversation, whether it's information, whether it's support on again, the knowledge side of things, or it's just growth of the advisors overall. Please feel free to reach out to any of your sales director, whether the life side, living benefit side. And again, as Angelina mentioned, we're truly here to support you as a growth advisor and here to support you.
Excellent, ladies. That was fantastic. And sometimes you forget all the services that you folks have at IA. So I've made some notes here that the cash wedge caught my eye. So I know that the investment team will get a hold of you for some webinars in the RSP season coming up. So we'll have you folks out to do some of those presentations. So that was fantastic. Thanks for your help today, Angelina and Rishu. Always a pleasure.